Hello and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta, back with your daily dose of commodities, cryptos and currencies. A quick read-through, first of all, on the global equity markets, where the stocks on Wall Street closed in the red. Steep cuts across the board. The tech-heavy Nasdaq fell nearly a percentage point, pulled down by shares of Nvidia. Market went into a profit-booking mode following cautious commentary from the U.S. Federal Reserve Chairman Jeremy Powell on valuation concerns, noting that the equity prices are fairly highly valued, is what he said. The stocks in the Asian Pacific also are trading on a mixed side, tracking some of those declines from the Wall Street. Back home, the Nifty is under some pressure, testing those 25,100 levels, as you can see on your screens. Shifting focus then to the crude oil prices, where we did see a spike in the overnight markets following a deal to resume exports from Iraq's Kurdistan stalled, pacifying some investor concerns as well that the restart would add to the global oversupply fears going forward. But as you can see, we are still working with those gains in the Asian markets right now. Meanwhile, the US dollar index has pulled back from those 97 levels. Now, the Indian rupee also has lost over 0.5% yesterday on significant profit-taking and FII selling and also buying of the US dollars. Looks like the weakness in the Indian currency is here to stay, with expectations that the Reserve Bank of India will in fact step in to prevent breaking past that 89 level as of now. Dhruv Goel is CEO of BigMint Technologies, and he joins us on the show to talk all things steel and metals there. Dhruv, hi, thank you so much for joining in. First of all, your sense on the overall macro markets to begin with. We still seem to be dealing with a Fed rate cut and the US dollar, and then, of course, tariff as a concern. How are you looking at the Indian markets per se?
Thanks a lot, Manisha, for having me on this show. The steel market specifically is not very good at the moment. There are many factors, as you rightly mentioned. Overall, the global market, we have seen a downtrend, especially from the China. If you see, the Chinese consumption has been down, in the first 8 months of this calendar year, wherein the production has not been down that much, so that the excess capacity is translating into exports, and that these exports are getting into different parts of the world and creating a pressure on the steel prices across the region. And apart from that, India at the same time is not very immune from the global market, so the impact is also seen on the Indian market as well.
Absolutely. Dhruv, the steel Seki, of course, spoke today, and I quote him as he says that the steel prices should become balanced given the safeguard duty and robust demand. He also said that they're expecting industry to show better revenues to trends in the coming months. So with that statement coming in, and there is, of course, some support that we've seen in steel stocks come in because of that as well. But how are you reading that statement?
I think it's a right statement. If you see, after the safeguard duty has been implemented, so safeguard duty was implemented on the flat steel, which contributes the maximum percentage of total imports of India. So if you see last quarter versus Q1 versus Q2, the flat prices have dropped only 4%, wherein the longs prices, which does not come under the ambit of safeguard duty, has corrected over 10%. So the fall in flat prices is lower compared to the longs prices. We feel that safeguard duty will definitely help. If you see the first 5 months of from April to August numbers of imports, the imports have dropped by 15%. So that will give some cushion for the steel makers to maintain the prices. But whether prices will increase in the coming quarter will be very difficult to say, because as mentioned that capacities are India has still enough capacities in the system. But one thing for sure, that prices likely to stay firm in coming months.
Dhruv, when you say that the prices will can continue to be firm going forward, what kind of price range or what kind of a percentage increase then are we working with?
Difficult to comment on the exact quantum, but I can tell you that for example, longs, as as I mentioned, that the steel is categorized into two categories: one, flat and long. Flat comprises of HR coil and CRC and galvanized. Longs is rebar, all the construction steel. So the longs market is largely catered or is contributed by the smaller players, which have over 60% of the market share. But for these players, the major raw material is, scrap, power, iron ore, coal. So these prices have not changed compared to the fall in steel prices. So they have very limited room to correct the prices. And in case of any correction in the prices, most of the mills have to undergo maintenance or shut down their operations. So we feel that prices will remain stable, or the downtrend is a little limited from here.
The market really seems to be working with and believing that the steel price hike perhaps is on cards. What's your reading?
I think on the ground, market does not expect a very steep hike. Maybe sentimentally there could be small hike, maybe 500 to 1,000 rupees in coming months, especially on the GST front, because what we have seen that after GST cut, there is some surge in demand in different sectors. But at the same time, what we expect that the demand will increase from the consumer end, but from the government end, there could be some decrease in the spending, especially at the state government's end. So it will be a net balance. So potential increase of maybe 500 to 1,000 rupees, but again, this will be more sentimental than the fundamental.
Dhruv, I was looking at the data, and if you look at the Jan to August last year vis-a-vis this year, we've seen some increase when you look at production as well as consumption numbers for the Indian markets. This is a bit different from what we've seen for the rest of the world, for sure for China as well. When you look at the Indian production and consumption numbers, do you see this trajectory continuing?
Yeah, I think production will continue to increase at maybe 8 to 9%. Last financial year, we produced approximately 152 million tons. This year, we are expecting 165 odd million tons. So the production is increasing at 8 to 9%, and so is the demand. And something which balances export and import are also fairly balanced, except that imports have dropped by 15%, but exports have also dropped by 10 to 15% because of several reasons. Because China is very active in the market. So it's net to net quite balanced at the moment. And this year we expect India to close their crude steel maybe at around 165, 167 million ton.
How are you also looking at the Chinese numbers then? Because there's a bit of a decline there when it comes to production as well as in sense of consumption as well. The slowdown in China is, of course, no secret, and we've seen those numbers continue for quite some time now. Do you see a stability at best, if not further decline?
So, you're right that there is a decline in the Chinese steel production as well as the consumption, but the steel production decline is lesser compared to the consumption decline. We have seen a structural decline in their property market. If I have to give you some numbers, 2021, the property market used to contribute 35% of the total steel consumption of China, which currently stands at approximately 25%. So whatever excess quantity which they have is getting exported. But typically this season, this period in China from October to December, this is a, pollution. They generally undergo maintenance because to maintain the pollution norms. So typically, for next quarter, we expect production cut to be higher what it was in the last quarter.
This whole conversation about China's stimulus measures, we've been hearing it about for some time now, and we've seen that come in bits and pieces, not so much on ground, but more of rhetoric at this point in time. How are you reading into that?
So these are, very frequent, announcement that come from the Chinese government, but it has, at least at the moment, it has not factored by the market, or market has not reacted to this news. Till now, the prices are very stable. We're not seeing any, very steep down or very steep up from here. So HRC prices would be hovering anywhere between 480, 485 FOB levels to China, which were very similar to what it was maybe a month or couple of months back.
They will also come in on the rest of the metals, because we've seen iron ore prices kind of stabilize as well. Have actually done better than what steel has done.
Yeah. So iron ore, the problem with iron ore is that, India, specifically talking about the Indian market, we have seen production cuts because of the heavy rainfalls in Odisha. So again, if you see April to August numbers, the Odisha production has dropped by 7% compared to the last year, and Odisha being the largest iron ore producer. So that has stabilized the iron ore prices in the domestic market.
Dhruv, there have been various reports to the effect that going forward, commodity perhaps is in a strong bull cycle for the next 6, 7 or 8 years as well, and metals could be a part of that. While we have seen big targets being set for metals like copper and aluminum, and to some certain extent zinc as well, do you see the same happen for ferrous metals?
Obviously, compared to non-ferrous metal like aluminium, copper, zinc, wherein the applications are the new applications are getting introduced. Steel will also see an incremental demand, but may not be as robust as aluminium and copper. But definitely, in the Indian context, steel is will remain bullish. Although couple of 1 year or maybe 1.5 years, there will be turbulence because of the higher capacity. But in the longer run, still the ferrous market looks bullish.
Dhruva, when you look at the Indian markets, and of course, almost everybody that you speak to does say that India is a bright spot amongst all of its Asian peers and in some sense the developed world as well, with the kind of incremental demand growth that we will see for many of these metals coming in the coming years, whether it's about infrastructure or construction or even about EVs and AIs in that sense. How are you looking at the overall Indian demand when it comes to for many of these metals, including steel and iron ore?
Of course. Still, the demand is very robust. The demand is not the problem. We always say that supply is a problem, and since steel is a very cyclic business. Somebody who has planned the capacity 5 years, these capacities get commissioned after after a certain period, and there are times when the capacity is higher than the demand, but it gets normalized. But if you see the Indian market, the consumption is very steadily growing at 8 to 9% per annum. And you rightly mentioned that different sectors contributing to this demand, be it property, be it real estate, be it infra, or be it new applications like energy transition or data centers. So India remains a bright spot in the global market.
Fair point that. Dhruv, always a pleasure talking to you. Thank you so much for taking us around with all things metals there, whether it's about China, international or the Indian markets, where we, of course, are looking at much positive numbers as compared to the global setup there. Thank you so much for your time. And with that, it's time now for a short break. Up next, we talk all things precious metals with Saiyam Mehra of All India Gem and Jewellery Domestic Council. Stay tuned. Welcome back. Saiyam Mehra is Vice Chairman at GJC and joins us on the show now. Saiyam, hi, thank you for joining in. And it has been all about gold and silver and diamonds all of this year, whether it is about the Indian demand, prices, or then, of course, tariffs as well. But I want to start with the gold prices, first of all. And we are trading at almost 43 to 45% on the higher side for this year. Your sense, first of all, on the gold prices. Are we done with this rally? Do you think it still has a room on the higher side? How are you reading the prices?
Previously, we were thinking, Manisha ji, that the rates will go till the year end. They will be approximately $3,800. But we are seeing in futures right now only when it is 3,777 right now. We are looking at already 3,800 right now in futures, and we are targeting, or the target now may come up to $4,100 till the year end. The market is right now close to 1,14,000. But what we are looking at MCX and in the market is 1,17,800. Approximately triple line with GST. We're looking at, I think, more 2,000 or 2,500 rupees to increase more in the next 10 to 15 days. The demand because of this has reduced a little bit, but overall, because of the Fed rate reduction and the two further reductions which we are anticipating right now, it is expected to be a bull run again for the next year and a half.
Oh, well, absolutely. It's all to do with the US Fed rates right now, where the markets are anticipating 2 rate cuts in this year and 1 in 2026, the first quarter. Saiyam, it's not just about gold. And while we do have higher targets continuing for gold right now, the chart should come in on your screens where it shows that for this year, while gold is gained up by 43%, silver is up 53%, you have palladium, which is up 40%, platinum price is up nearly 67% as well. Would you say it's basically confluence of a lot of fundamentals right now? Because on one side, we have weakness in US dollar. We also are looking at safe haven buying. And then it also is about deficit for many of these metals, barring gold. So when you look at silver, platinum, palladium, the kind of run-up that we've seen in these metals as well, do you see that holding well, continuing higher?
No, definitely. I feel that the way the Fed rates have reduced, the way other major central banks are buying gold, I think that the other silver also is going to give more returns. 43% returns we've seen in gold, 53% we are seeing in silver. Further, it is expected that 65 to 70% returns can come in silver and maybe 53% returns can come in gold. And for other metals also, we are looking at further rates going ahead. We had seen record buying of 27 tons approximately in the last few days of the ETFs. So I think in gold. So I think going ahead, we are looking at gold further increasing, and dependency on US dollar is further decreasing. We've seen a dollar index also come down to 97.53 approx, and we are looking at rupee also to go above 88.8. It is expected to go to 89.5 or 90 in the coming few months. So expect overall in the Indian markets, gold is expected to increase overall, and the investment in gold is going to give, of course, better returns than any other commodity or any other capital markets.
We already have seen that. Saiyam, when it comes to the international markets, we understand that the best way of investment for the longest time has been via futures or options, and ETF really seems to be picking up right now. For the Indian markets as well, we've seen the best pace in last 3 years when it comes to gold buying via ETF. So the investment demand really seems strong. When it comes to the physical market, are a lot of people buying gold in physical as well in sense of investment?
No, we had in the last 4 to 5 days, jewelry selling has reduced.
Okay.
People are coming in showrooms and want to buy gold coins and bullion. So they are anticipating more rate hike, but jewelry selling per se has reduced by 20 to 30% in spite of Navratri pushing in. Rates are expected to we were expecting the rates to get stable, but every day there is a hike of $10 to $15, sometimes $30 in the USD. And from last week to this week, 3 lakh rupees, the rate has increased to 3,000, the rate has increased. So the customer is getting jittery, and he's feeling that every day when they are going to buy the gold or gold jewelry, the rates are increasing. But somehow they have got used to it. So it is being seen and being converted more into bullion or coins and less into jewelry. We are anticipating more sales in the coming next week, but this week it will take, there's a knee-jerk reaction which has happened in gold, so it will take time for the end consumer to get used to these rates. But I feel that the rates of above 1,12,000 to 1,13,000 in MCX has become the new reality, and 3,650 in COMEX has become the new base when it comes to gold.
Same, when you look at the international markets, the gold caratages being bought is anyways on the lower side. India buys 22 carats. Even the Middle East buys 21 carats for that matter. And then you have the Western world, which buys anywhere between 18 and 14 carats. India has 9 carats being allowed as well. When it comes to buying for India, do you think we are moving towards lower caratages? Or as you said, it's more about investment. People are buying coins and bars. I'm assuming that is still in 22 carats. Are we sticking with higher caratages for the Indian markets?
No, when it is coming to investment demand, people are buying 24 carat gold bars and gold coins. In jewelry buying, the end customer has made a preference after 22 carat to 18 carat also. 18 carat is being sold and is now in all the racks of the retailers. 18 carat jewelry has started coming in. They have started buying it because it is not only lighter in weight, but 17% cheaper than the 22 carat also, which is 75. And I think in the coming 2 years, the gold market will also reduce to 14 carat, and another 3 years time to 9 carat. Diamond jewelry already the end consumer is preferring 14 carat and 9 carat. Previously, that was being exported to the US markets also. But now the manufacturers and retailers are also motivating or advertising the end consumers to buy 9 carat diamond jewelry and 14 carat. But in gold jewelry, people have not reduced from 18 carat to 14 carat. Will take a time of 2 years at least.
Simon, coming on exports as well, as you mentioned that, and we've seen 50% tariffs still on. I understand there are conversations going on, and we perhaps will see those tariff numbers come down at a more rationalized levels. You've exported to US, you do export jewelry to various other parts of the world as well. How has your experience been with all of these tariffs ongoing?
See, I'm exporting to the US. US for gold per se has the sales have reduced marginally. But for diamonds, it is the casting is coming from the US. Then they are manufacturing here, or they are putting their diamonds inside. On the labor part only, On the labor part, only the tariff is being affected. So I don't think there are different ways which have been found now to export the jewelry via some part of it being manufactured in the US, then coming here, making it and sending it back again. So there has not been much of an effect when it comes to the diamond exports. Gold per se has been affected a lot. It has been very difficult for us to export now to the US. We are, of course, exporting to the Gulf market, to Malaysia, to Singapore, to UK, to Australia. But for us as a gold manufacturer, our exports have diminished to the US.
Sayam, almost everybody else seems to be looking at other parts, other major countries. I mean, as you mentioned, there's various countries in Asia. The GCC seems to be opening up for the Indian handiwork as well. How, do you see in the next quarter, the first quarter, first half of 2026, the other markets start to open up much more for India?
See, previously we had never made an effort to go to other markets because US was giving an excellent support to most of us manufacturers. But now it seems that there is no option. We have to look into the Middle East market. We've had FTAs with Australia, with UK, other countries in Europe also, where the Indian government, the Commerce Ministry is planning to have its FTAs in place. I think once that is done, we'll take a time period of 3 to 4 months more. But I think with the domestic markets also, we are focusing on domestic also and exports also these areas. 5 to 7, not more than 5 to 7% of effect in exports should come because of the US tariffs.
Saiyam, the idea is not to put you in a corner, but I have to ask you this because almost everybody in the international markets is now eyeing the Indian festival season. And as you said, there is investment which is slightly higher and then jewelry slightly on the weaker side. But at the end of the year, it really is going to be about the tonnage. And this is the most important period for your segment, for the jewelry segment, for gold and diamond and silver and platinum jewelry, everybody. What is the kind of numbers that you're working with and what we would see? We do understand that the last 2 quarters weren't so great. This quarter perhaps slightly better. The next quarter is what it all means about. How are you looking at the numbers stacking up?
See, I think that if you see the Dhanteras day last year, if it may be 22 to 24 tons, this year may come down by 10% to 18 to 20 tons that day itself. Going ahead also, if you see, we have imported also about 7 to 8% lesser than last year, the gold figures. April imports of this year are 35 tons when last year it was 40 tons. May was 31 tons. Last year was 41 tons. June is 25 tons. Last year was 35 tons. And July this year was 43 tons when last year it was comparatively 48 tons. So if you see comparison for the last year to this year, the import figures also have been comparatively lesser than last year. And we are expecting this quarter also, or this October also, to be very good. But volume wise, still how much of an effort as a jeweler, we all make 10% reduction in volume will be there. At the same time, 35% or 38% increase in value terms will be the new scenario. As the end consumer, whenever they come in the shop, they want to buy value wise. They don't look into the grammage.
All right. 10% decline in volume, 35% increase in value. And of course, Dhanteras could be slightly on the weaker side. Last year's was 24 tons. This year could be 20 tons is what the numbers are coming in from the market. Saiyam Mehra, always a pleasure talking to you. Thank you so much for taking time out for us today. And with that, that's all the time that we have on CNBC TV 18 Prime's Big C. Thank you for watching.